Every model said it couldn't happen. Every Nobel sealed it with prestige. In 1998, a hedge fund run by the smartest people in the room, literally, nearly took down the global financial system with trades that looked riskless on a spreadsheet and lethal in the real world. They called it long-term capital management. Long-term capital management. But when spreads blew out and margin clerks started calling, it turned out they had none of the three. That's the paradox of genius in finance. You can measure everything except the moment when the market decides you are no longer entitled to time. This is the crash cabinet, where money, power, and history collide, and nothing is ever as simple as it looks. LTCM wasn't just a fund. It was a thesis about how markets behave, how risk can be tamed, and how intelligence can be engineered into profit. For a while, the thesis printed money. The line of returns climbed as if gravity had been outlawed. Then the world refused to act like the past. The story of 1998 is the story of what happens when brilliance meets leverage, when liquidity masquerades as safety, and when the most powerful person in finance isn't the laureate who wrote the formula or the trader who found the basis. It's the clerk who says, post more collateral by 4 p.m. For centuries, finance rewarded those who noticed tiny, boring mispricings. An older treasury bond yielding a whisper more than the shiny new issue. A swap curve out of tune with the government curve. A convertible bond worth slightly more than the stock, plus an option. A pair of equities that behaved like siblings but were priced like strangers. Arbitrage, in theory, is the closest thing to free money, if you can fund the waiting. By the early 1990s, computing power met academic ambition. The Black-Scholes Merton world promised maps through chaos. If you diversified across hundreds of small convergence trades, the idiosyncrasies would cancel out, and the law of large numbers would do what it always does, turn noise into a salary. John Merriweather, a legend from Salomon Brothers, gathered the cohort, traders who knew how the street really moved, quants who could formalize edge, and scholars, Robert Merton and Myron Scholes, whose names lived in textbooks and on trading floors. Build a book of relative value trades that usually work, hedge the obvious risks, and lever the remainder until it matters. If a mispricing is 1% and you lever it 25 to 1, you've engineered genius into a paycheck. The promise was elegant. Find small, high probability convergences, borrow to scale them, smooth the ride with diversification and value at risk. Deliver a return stream so steady it looks like a government bond wearing a tuxedo. The machine they built was a precise clock. Each gear was a market-neutral position. Short the rich on-the-run treasury, buy the cheap off-the-run cousin, harvest the spread between government bonds and interest rate swaps the way farmers harvest wheat, slowly, predictably. Buy Italian or Japanese bonds that look cheap relative to German bonds. Hedge the currency. Wait for the day the market remembers that math exists. Go long the convertible that underpriced volatility. Hedge the stock. Keep the option decay. Sell options when implied volatility sat above what the world usually delivered, because usually is a soothing word. Each trade was tiny and in isolation dull. Together, with billions in funding and an aura of invincibility, they became a river of money. The returns were tranquil, almost boring, and boredom at 30% annualized is the best drug on Wall Street. But tranquil surfaces hide undertows. The entire thesis depended on two fragile assumptions. First, that you could always fund your positions long enough for the world to become reasonable again. Second, that the world AS definition of reasonable would stay inside the bands measured by the past. In August 1998, both assumptions failed. Russia defaulted on its ruble debt and declared a moratorium on paying certain obligations. On the surface, a faraway event. In the bloodstream of finance, a shock that turned every complex position into a simple one. Fear did what fear always does. It stampeded toward the most liquid, most pristine collateral, the newest U.S. treasuries, while selling anything that relied on a promise of eventual convergence. The exact opposite of LTCM's core bet happened everywhere at once. Off-the-run treasuries cheapened further, corporate and emerging market spreads gapped, swap spreads kinked. Correlations that supposedly canceled one another stood up, shook hands, and marched in formation against the book. The models had treated Russia as a local fire. The market treated it as a universal solvent that melted every relative value pair. When prices move fast enough, risk isn't your only enemy. Time is. Arbitrage relies on waiting. Waiting relies on credit. As spreads blew out, margin calls hit with the rhythm of a war drum. The fund needed to post more collateral, now to hold positions that would eventually converge. In theory, you hold and win. In practice, if you cannot post the cash, your counterparties can liquidate you into the worst prices of the worst day. If you need to sell to survive, the market prices your intelligence at zero. LTCM's book was huge and crowded. The phrase, the LTCM basis, floated across trading floors because so many had shadowed the fund AIGA trades. When LTCM tried to sell what it could to raise cash, everyone else was selling the same thing for the same reason. Liquidity evaporated. Bid-ask spreads yawned. Model risk became liquidity risk. Liquidity risk became solvency risk. You could hear the gears of the clock grind against one another, metal on metal, math against margin. The margin clerk always wins. Then the phone tree lit up. The fund wasn't just big, it was entangled. Derivatives and repo lines with nearly every major dealer made LTCM's portfolio a web of obligations spread across the balance sheets of the world's largest banks. If the fund defaulted, the dealers would inherit an explosive, disorderly unwind. Forced sales in markets already on fire. An idiosyncratic hedge fund risk had become systemic clearing risk, a conference room in New York filled with the names that anchor history. The solution wasn't charity, it was self-preservation. A consortium injected capital, took control, and agreed to an orderly unwind. The central bank did not write the check, but it coordinated the room, and soon after cut rates to calm the broader organism. The smartest trade on earth socialized its tail risk through the architecture built to prevent a bonfire of collateral. The easy retelling is a morality play about hubris, and there is truth there. But the deeper lesson is structural. Leverage plus liquidity equals reflexivity. If your profit depends on the ability to hold, your primary asset is not the bond, not the option, not the swap, it's time. When time is withdrawn by collateral demands, your position morphs from convergence to forced liquidation. Correlation isn't a law of nature. It's a rumor that holds until a bigger story enters the room. Diversification across independent bets collapses when the shock is macro, a funding shock, a volatility shock, a collateral shock. The whole book becomes a single wager that the world stays within historical variance. When variance itself is repriced, correlation goes to 1. Value at risk is a thermometer in a house with a gas leak. It tells you what usually happens, not what matters. A 5 sigma event is a myth that comforts busy people. What happened in 1998 wasn't supernatural. It was the market doing what markets do under stress, preferring cash now to fairness later. Crowding kills edge. If your advantage is structural, funding cheaper, warehousing risk longer, perhaps it scales. If your advantage is merely that you can see a basis others can see, then you are renting a public view. A crowded trade with leverage is a powder keg. Genius is a position size. A brilliant thesis with conservative leverage is education. The same thesis at 30 to 1 is religion. Many of LTCM's trades were right. Eventually, they converged. But the market does not pay the person with the best idea. It pays the person who remains solvent long enough to collect. Consider one trade that looks like a law of nature until it isn't. T, the on-the-run versus off-the-run treasury basis. The newest treasury issue trades rich because it is liquid, a benchmark everyone wants to own in finance. Older, nearly identical bonds trade cheap. Buy the cheap one, short the rich one, earn the yield pickup plus the expected convergence as the new issue ages. In calm seas, the spread narrows and funding is easy. In a storm, demand for the liquid benchmark surges, the off-the-run lags, and the spread widens just as your leverage magnifies the pain and your lender calls for cash. To fund the margin, you sell something else, maybe an Italian bond versus a Bund, but everyone else sells the same thing. Suddenly, every basis widens. What looked like diversification reveals itself as an echo chamber. You are no longer an arbitrageur. You are the market's balance sheet of last resort. And the market has decided you aren't. Reputations are collateral until they aren't. The roster projected invincibility, and that halo became part of the strategy. Counterparties extended lines. Investors tolerated opacity. Rival desks shadowed the trades. Genius for a season lowered the cost of capital. Then losses mounted and the halo inverted. The same names that had attracted capital now attracted scrutiny. Confidence is a binary option. It pays until it pays nothing. In a culture built on always being right, the first public wrong is not a line on a chart. It is a regime change. Overnight, partners become risks. When the rescue was engineered, some called it a bailout, others a shakedown, still others a necessary evil. The deeper truth is colder. Systems prefer continuity to justice. The objective was not to reward or punish. It was to avoid a fire sale through the core of the financial system. Bank balance sheets, money funds, pensions, insurers, all the places where ordinary savers live without knowing what a swap spread is. Expect path dependence, not fairness. If your failure imposes costs on the system will cushion you or crush you in an orderly way. Either way, confidence is the client. You are not. History didn't stop in 1998. It took notes and wrote sequels. In August 2007, crowded quantitative equity strategies hemorrhaged together when leverage and similar signals created a chain reaction. Different instruments, same melody, crowding plus leverage plus a funding shock equals correlation 1. In 2008, an insurer sold volatility for nickels and was margin called into nationalization when the hurricane arrived. In 2021, a family office hid concentration through total return swaps. When prices moved, prime brokers demanded collateral and then raced each other to sell first. Across decades, the pattern holds. Genius finds a small edge. Leverage prints money. A shock reveals the common factor. Funders demand cash. Positions become prices. Rescue or ruin follows. Lessons are learned and then monetized. Again. So what survives, and what can be used beyond a case study in catastrophe? Beware of straight lines. Returns that look like free income often hide a short volatility position somewhere in the plumbing. Know your funding. If your plan requires time to work, secure the ability to buy time under stress. If you can't, you're more leveraged than you think. Treat correlation as adversarial. In a crisis, assets that introduce themselves as strangers discover they attended the same school. Respect liquidity as a price, not a feature. In good times, you pay for liquidity so that in bad times it might pay you back. If you never pay, you won't receive. Size like a coward. If an edge vanishes when you have your leverage, you didn't have an edge. You had confidence. Read the footnotes and count the counterparties. Concentration is not just what you own, it is who you owe and who owes you. Picture for a moment the scene in the room when the spreadsheet replaced the story. Position lists stacked high. Spread charts with 20-year histories suddenly off the page. A matrix of counterparties, each with red boxes around exposure caps. Coffee cooling in paper cups. Voices low, clipped. No villains, no heroes, only balance sheets trying to survive a storm of their own design. Across the table, rivals who envied those smooth returns tally the cost of letting pride have its funeral. It isn't empathy, it's netting. When the numbers say live, the wires go out. The unwind begins. The trades recover after the holders change. Why do smart people blow up? Intelligence compresses reality. It finds the essence, the elegant core, the pattern that turns 1,000 cases into one rule. Markets, under stress, decompress reality. They expand the set of possibilities you excluded. The smarter you are, the cleaner your map. The cleaner your map, the larger your blind spots. That isn't a flaw in intelligence. It is a flaw in certainty. Genius and humility can coexist. Genius and need cannot. If your structure requires the world to remain reasonable for you to survive, the world has already negotiated your surrender. It just hasn't chosen the day. What was LTCM, really? A fund? Yes. A set of positions? Yes. But more than that, it was a demonstration that debt is the ultimate derivative. When you borrow to express a view on how the world should be, you aren't only betting on price. You are betting on the world's willingness to fund your belief until that belief becomes true. In 1998, that willingness ran out first, and the math ran out second. The crisis didn't reveal that arbitrage is fake or that models are useless. It revealed that the market prices patience, and that price is set by people who don't care how smart you are. The final accounting is brutal and clean. LTCM proved that intelligence can price relationships, but only liquidity can survive their betrayal. It proved that diversification works right up until the funding factor dominates everything else. It proved that when markets convulse, the people who decide the future aren't always the ones with the best ideas. They are the ones with the cash, the collateral, and the authority to say, you may hold, or you must sell. That authority often lives with the most unglamorous character in the story. Not the trader, not the academic, the margin clerk. So when you hear about riskless spreads, safe income, models that bound the future, remember 1998. Remember the smartest people in the room discovering that the power to demand cash now will always beat the promise of fairness later. 4. Remember that markets are made of balance sheets, and balance sheets are made of time. When time is expensive, genius is cheap, and when time is revoked, genius is worthless. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.